Vietnam is emerging as a low-cost alternative to China. Intel, for one, will open a $1 billion plant near Ho Chi Minh City later on this year. But is Vietnam ready to compete for China's title as a world factory? Bloomberg's Hussein Amin filed this report from Vietnam's financial capital.
Thuyen says she's happy working in this towel factory. Conditions are comfortable and her wages are good. Just across the border in China, the situation is very different. Thousands of workers went on strike recently demanding higher wages for their 12-hour days. Thuyen's employer, Korean company Terry Gallery, is reaping the rewards of its operations based 2 hours away from Ho Chi Minh City. Its towels go even further to luxury hotels like the Ritz-Carlton and Hyatt in Seoul.
Multinationals like Terry Gallery have chosen Vietnam over China. Cost is key. The workers here are paid half the wages of their Chinese counterparts.
Labor costs increase 10% every year in Vietnam. We produce towels, and when you compare production costs, what would cost us $1 in China would only cost us 80 cents here in Vietnam.
15 years of tax exemptions keeps costs low too, and that's enough to convince Terry Gallery to shut all its China factories and move them to Vietnam. Now, Korea's biggest towel maker plans to triple its current production to 30,000 in the next 12 months. And that means hiring more skilled workers like V, a mechanical engineering graduate.
I receive about $250 1 month.
V's happy and so are foreign investors. Vietnam attracted a record $10 billion in foreign investment in 2008. Even so, that's just a fraction of China's $148 billion.
Vietnam still fares in comparison by sheer size of the country. So I think it's better to think of it as complement to China.
And perhaps the streets of the financial capital say it all, that Vietnam's future, especially in manufacturing, will depend on its commitment to improve its infrastructure. Haslinda Amin, Bloomberg, Ho Chi Minh City, Vietnam.
Okay, so just as the video say, cost is the key. So this is what we're going to be looking at today in chapter 9, which is the management of the economic exposure, how company can manage its costs and labor and so on. So let's start it. Okay, so chapter 9, we will cover another type of foreign exchange risk and discuss the risk of the management technique for economic exposure, the extent to which, the extent to which the value of the firm will be affected by exchange rate movements, and we will discuss the major economic exposure, what determined it, and how to manage and hedge the economic exposure. So changes in exchange rate can affect a firm balance sheet and an income statement. So as business become increasingly global, more and more firms find it necessary to pay careful attention for foreign exchange exposure and to design and implement appropriate hedging strategy. So changes in exchange rate can affect not only firms but also firms that are directly engaged in international trades and also purely domestic firm. For example, a Thai car manufacturer sources only domestic materials and sells only to the Thai market, but with no foreign currency receivable or payable in its accounting book. So this seemingly purely domestic Thai firm can be subject to foreign exchange exposure if it is competing with other companies or importers, says the Japanese car manufacturer. So when the Japanese yen depreciate against the Thai baht, this is likely to lead to a lower Thai baht price of that Japanese car. So this will boost the sales in Thailand and therefore hurting the Thai manufacturer. So as you could see, the Thai company can be affected even if they are not exporting to elsewhere. So this lecture will outline how to measure the economic exposure, what is operating exposure, an illustration of operating exposure, the determinants of operating exposure, and how we could manage it. So firstly, let's look at the foreign exchange risks and economic exposure. So foreign exchange risk, as we have been going through quite a number of weeks, it is the economic exposure focuses on the impact of the currency fluctuation on the firm values. So changes in the present value of the firm or long term as a result of the changes in the exchange rates. And the expectation about the fluctuation must be incorporated in all the decisions of the firms. Sorry, I have made some slight changes since I sent it to Kun Bongkot, but I will give you the updated one later on. So what is accounting exposure and how it could impact on the firm's balance sheet? And we will look at the economic exposure, which are transaction, which is including contractual, present value, and short term, and operating, which would be longer term and in the future. So we look at the real exchange rate and risk, the nominal versus the real exchange rate. Anyone know the difference between nominal and real exchange rates? So nominal is when you have already adjusted for inflation. The real exchange rate is the pure exchange rate, the spot exchange rate that doesn't take into account inflation rates. So that's what's the difference between the two. So the economic impact of a currency change will depend on the offset by the difference in inflation rate or the real exchange rate. And it is the relative price change that ultimately determines the firm's long-run exposure. As for transaction exposure, that can be on balance sheet, which is the existing contract that you have, and it can be an off balance sheet, which is the contract in the future, like the loan repayment or the lease that you made in the future. And there can be assumption which can be flawed, that is your expectation may not be right. The LC cost and revenue remain constant. LC is the letter of credit cost. That is what you enter into with the bank that you promise to pay your customer in the future. So operating exposure involved real rate change, and it led to changes in the relative prices and demand for your and your competitors' products. And this is based on the price flexibility, which will depend on the elasticity of the demand, the product differentiations, and the substitution of input and shifting production. So in summary, the sector of the economy in which the firm operates, the sources of the firm inputs, and the fluctuation in the real exchange rate this is the economic consequences of the exchange rate changes. So one of the case study is with the economic exposure is with Toyota. So the exchange rate risk has affected both Toyota revenue and costs, and trying to decrease the exposure may result in the flowback effect. So previously, the exported good returned with increased domestic competitions and lower profit margin domestically. And we will see, I will show you the example in the afternoon about Toyota. So the question is, suppose that your company has an equity position in a French firm. So discuss the condition under which the dollar or the euro exchange rate uncertainty does not constitute exchange rate exposure for your company. So suppose that your company has an equity position in a French firm. So discuss the condition under which the dollar per euro exchange rate uncertainty does not constitute exchange exposure for your company. So only if changes in exchange rate does not necessarily constitute currency exposure. So the changes in exchange rate, the normal daily changes, doesn't mean that you will be exposed to currency risk. But if the euro value of the equity move in the opposite direction as much as the dollar value of the euro change, then the USD value of the equity position will be intensive to exchange rate movement, and therefore your company will not be expected to a currency risk. Okay. So let's look at economic exposure. So this is the changes in exchange rate can affect not only firms that are directly engaged in international trades, but also purely domestic firms. Okay, so if domestic firm products compete with import goods, then their competitive position is affected by the strength or the weakness of the local currency. So consider a U.S. bicycle manufacturer who sources and produces and sell only in the U.S. So since firm product compete against the import bicycle, it is subject to foreign exchange exposure, and therefore their customers are comparing the cost and the feature of their domestic bicycle against those competitors such as from the Japanese, British or the Italian bicycle. So exchange rate risk is applied to firms' competitive positions. So any anticipated or expected change in the exchange rates would already have been discounted and reflect in the firm's value. And economic exposure can be defined as the extent to which the value of the firm would be affected by the unanticipated change in exchange rates. So everyone understand what unanticipated mean? This means unexpected. So if you anticipate something you expected, unanticipated is unexpected. So economic exposure will be the extent to which the value of the firm would be affected by the unexpected change in exchange rates. And economic exposure will depend on the unique characteristic of an industry. For example, which industry your firm belong to will also have an effect on your economic exposure. And the individual characteristics of an individual firm. So every firm is different, therefore they will have a different kind of economic exposure. So one way to measure this economic exposure for an industry is to calculate what is called a forex beta. And this is shown in Exhibit 9.1 in your book. So as you could see, the market beta. So if you have taken some research paper, I'm not sure, or statistics. So market beta is the measure of systematic risk. So it's the market risk of each industry. As you could see, let's see which industry has the most risk. So it should be transportation and equipment from here. So in the U.S., the exchange rate exposure of U.S. industry portfolio, the transportation equipment will have the highest market risk. And as for the foreign exchange beta, which is the foreign exchange risk, so 1 will equal to, so the more beta, the more higher risk. So as you could see, textile will have the highest forex beta. So this is an example of how they measure foreign exchange risk. Oh, sorry, it's on the slide as well. So let's see how to measure economic exposure. So the currency risk or uncertainty which represent the random changes in exchange rate is not the same as the currency exposure, which measure as what is at risk. So under circumstance, a firm may face any exposure at all time, and that is nothing is at risk, even if the exchange rates change randomly. So for example, your company has a vacation home for your employees in the countryside like Hua Hin or whatever, and the local price of this property or the house is always moving together with the Thai baht price of the USD, because Hua Hin is a foreign attraction, tourist attractions. So the property price is always affected by foreign demands. Therefore, whenever the Thai baht depreciate or go down against the dollar, the local currency price of this property will go up by the same proportions. So in this case, your company is not exposed to currency risk, even if the baht per dollar exchange rate fluctuates randomly. So another example is when the local baht price of your company's Thai asset barely changes. So in this case, the dollar value of your asset will be highly sensitive to the exchange rate, since the former will change as the latter do. Sorry, there's a typo here. So to the extent that the dollar price of the Thai asset shows sensitivities to exchange rate movement, your company is therefore exposed to currency risk. And similarly, if your company operating cash flows are sensitive to exchange rate changes, the company is again exposed to currency risk. Therefore, economic exposure is the sensitivity of the future home currency values of the firm's assets and liability and the firm operating cash flows to the random changes in the exchange rates. So there exists a statistical measurements of sensitivities, and the sensitivity of the future home currency values of the firm asset and liability to the random changes in the exchange rates. And the sensitivity of the firm's operating cash flows to random changes in exchange rate will be illustrated next. So here you can see that your home currency value of the asset and liabilities and the firm values, the future operating cash flows, the exchange rate fluctuation will cause an asset exposure to your home currency value of asset and liability. The exchange rate fluctuation will also have an effect on the operating exposure, which affects the future operating cash flows and therefore affected your firm value. So it's a cycle of economic exposure. So we can measure it with regressions. So if a U.S. multinational company were to run a regressions on the dollar value of its British assets on the dollar-pound exchange rate, that is the spot of dollar per pound. So the regression would be formed as the follow, where P is the dollar value of the British asset, and S is the spot exchange rates. E is the residuals, and A is the regression constants. So if you run a regressions on it, statistically, you can measure the economic exposure of your companies. So the exposure coefficients, which is B, is defined as the covariance of P and S divided by the variance of the S. So where covariance of P and S is between the dollar value of the asset and the exchange rates, and the variance of S is the variance of the exchange rates. So the exposure coefficients show that there are two sources of economic exposure. So first is the variance of the exchange rates, which is this one, the variance. And secondly is the covariance between the dollar values of the asset and the exchange rates. So these are the two sources of economic exposure. So suppose U.S. firm has an asset in France whose local currency price is random, which is it fluctuated. So for simplicity, suppose there are only 3 states of the world and each state is equally likely to occur. The future local currency price of this French asset, which is marked as P and Astra, as well as the future exchange rate, which is noted as S, will be determined. And depending on the realized state of the world, there will be 3 cases here. So for case 1, the local currency price of the asset and the exchange rate are positively correlated. Okay, so it's positively correlated because the changes in the spot from $140 per pound to 1.5 to 1.6 also shows that there will be a positively correlated change in the spot price multiplied by the P, which is the local currency of the French asset. So that the depreciations or appreciation of the pound against the dollar is associated with the decline or the rising of the local currency because there's a positive correlation. When one moves positively, another moves together. So the dollar price of the asset on the future or liquidation date can be 1,372 or 1,500 or 1,712. So this depends on the realized state of the world. Whether it's case 1, the probability can be 0.33, case 2, 0.33, and case 3, 0.33. So when we compute the parameter for case 1, we obtained the covariance of 34 divided by 3 and the variance of 0.02 divided by 3. Therefore, the beta is 1,700 pounds. So this is computed by using regressions, and we won't be able to do that here. So the pound amount of 1,700 represent the sensitivities of the future dollar values of the British asset to the random changes in exchange rates. So if the spot exchange rate change from 140 to 150, this will show the sensitivity of the future dollar values of the British asset. And this finding implied that the U.S. firm faced substantial exposure to a currency risk. Let's see case 2. So for case 2, the local currency price of the asset and the exchange rate are negatively correlated. And the effects of the exchange rate changes is exactly offset by the movement of the local currency price of the asset. So this rendering the dollar price of the asset totally insensitive to exchange rate changes. So as you could see, there's negatively correlated, and this led to a constant, which means insensitive to the exchange rate changes. So it remained at 1,400 for each of the 3 possibilities. So the future dollar price of the asset will be uniformly 1,400 across 3 states. And one can therefore say that the British asset is effectively denominated in terms of the dollar. And although this case is clearly unrealistic, it shows that the uncertain exchange rate or exchange risk does not necessarily constitute exchange exposure, since these 3 are constants. So despite the fact that the future exchange rate is uncertain, the U.S. firm has has nothing at risk in this case. Since firm face no exposure, therefore no hedging is necessary. And lastly, we look at case 3. So here the local currency price of asset is fixed at $1,000. So in this case, we could say that the U.S. firm face contractual cash flows. That is, it is denominated in pound. And this case represents an example of economic exposure as well as transaction exposure. So intuitively, what is at risk is the £1,000, that is exposure coefficient is £1,000. Okay, so we have looked at the economic exposure. Now we're going to move on to operating exposure. So what is exactly is operating exposure? So why many managers understand the effects of the random changes in the exchange rates on the dollar value of their firm asset or liability, and which is denominated in the foreign currency, they often do not fully understand the effects of the volatile exchange rates on the operating cash flows. So as the economy becomes increasingly globalized, more and more firms are subject to international competitions. The fluctuations of the exchange rate can therefore seriously change the relative competitive positions of the firms in the domestic and in the foreign market, affecting their operating cash flows. So unlike the exposure of asset and liability like account payable or account receivable that are listed in the accounting statements, the exposure of operating cash flow will depend on the effects of random changes on the firm's competitive positions, which can sometimes cannot be readily measurable. So it is therefore important for firms to properly manage the operating exposure as well as their asset exposure. So therefore a good definition of operating exposure is the extent to which the firm operating cash flows are affected by the exchange rates. So everyone follow? So operating cash flows is how the firm's cash flow will affect by the exchange rates. So in operating cash flow, the firm will face first is a balance sheet exposure, or what we sometimes call asset exposure. So from the effects of the exchange rate change, this will have on the account payable, account receivable, or inventory, and loan in foreign currency, investments such as certificate of depository or CD in a foreign bank, for example. So all of these are in your balance sheet, and the changes in the exchange rate will affect your balance sheet exposure. How about the operating exposure? So this is the extent to which the firm operating cash flows are affected by the changes in exchange rates. So remember, when you do your accounting report, there will be difference between balance sheet and the cash flow statements. So this is how it is different. There can be balance sheet exposure as well as cash flows exposure. So when you're doing your project, you will see whether your company is affected by the balance sheet exposure or it is affected by the cash flows or the operating exposure. So let's have a look at the illustration on page 229. This is on the Albion Computer, which is a UK subsidiary of a US multinational companies, manufacturer and sells the PC or personal computer in the UK market. So Albion has bought Intel microprocessors from the US at 512 as an imported input. So the current spot price is 1.6 per pound. So the cost in pound for the import input is, you take 512 divided by the spot current exchange rate. So this is the cost of the import input. And the company also buy locally sources input at 330 pounds for a total input cost of 650 pounds per PC. So you add up 320 US plus the 330 UK. So see projected cash flow statement in Exhibit 9.6. So as you could see, the sales of 50,000 units at 1,000 pounds per unit will cost 5 million pounds, and the variable cost would be this. Therefore, after taking into account the fixed overhead costs, the depreciation, the net profit before tax will become 1.25 million pounds. And then they are subject to the income tax at 50%. So the profit after tax will be 6.2 millions. The profit and then add back depreciations. The operating cash flow in pound will be 7.25 million pound, which is equivalent to 11.6 million USD. So as we could see before, operating cash flow in pound is 7.25 million. Operating cash flow in dollar is 11.6 million. So therefore, there are two effects happening here. So first is what we call conversion effects, or the static. Static means it's not changing. So without any change at all in the selling price or P, or the number of units sold, or the quantity, the operating cash flows will be lower both in pound and in dollar, since the price of the imported input, which is the Intel chip from the US, is higher. The second effect is the competitive effects, or what is called the dynamics, which is changing. The firm's competitive position may worsen if the firm has to raise its price to try to cover the higher pound cost of the imported input, and it will therefore lose some customers since it is facing a downward slope demand curve for its products. So as an illustration of the operating exposure, so there was an enormous shortage in the shipping market from Asia due to the Asian currency crisis that happened in the 1997. And this affects not only the shipping companies, but also those retailers who experienced the increased costs and delays. So with the Asian currency crisis, this also affected the retailer for both the cost of shipping and the time. So noted that the exposure for the retailer has two components. So first is the competitive effects. So this is when there's a difficulties and there's an increased cost in shipping. So this is all affecting your operating in the daily of your business. Then there's a conversion effects, which lower the dollar price of the imports due to the foreign currency exchange rate depreciation. So operating exposure is determined by, firstly, the structure of the market for the market input, or the labor and material that you use in the company. And then B is the company's products itself, which is the input, the resource market, and product market. So how the market structure affected the operating exposure. Secondly, the firm's ability to offset the exchange rate changes by adjusting its market, product mix, and sourcing. For example, given that profit is equal to the price minus the input cost, The general rule is that a firm has operating exposure when either the price, the cost is sensitive to the changes in the exchange rate, but not both at the same time. So if the price and the cost are equally sensitive, or if neither the price nor the costs are sensitive, then the firm has no major operating exposure. So be aware when analyzing the company that you're using for your projects, you should see whether both the price and the cost are equally sensitive, the price of their products, the cost of their productions, or if neither of these are sensitive, then the firm might not be hedging at all because there's no major operating exposure. So recall that operating exposure cannot be readily determined from the firm's accounting statements, as can transaction exposure. So the firm operating exposure is therefore determined by the market structure of the input and the products. So how competitive or how monopolistic the market facing the firm are. For example, a car manufacturer. So how is the market structure of a car manufacturer? Is it very competitive? You could see that there's many brands for the car. And is it a monopolistic market? No, it's not, because there are other competitors in the market. And then the firm's ability to adjust its market, its products mix, and the sourcing in response to exchange rates. As we will see in the example with Toyota, shortly it adapted to the products mix. For example, in the high end it bought Lexus, and then in the low end it produced a small eco car. So this is how it adjusts to its market and the products mix. And that is the firm's flexibility regarding to the production location, where the firm chooses to locate its manufacturing site, its sourcing, for example, whether it sources a local employee or bring its staff with it to its new production site. And financial hedging strategy is also important determinants of its operating exposure to exchange rate risk. So I give you guys a break, 5 minutes break. Okay, let's resume. So determinant of operating exposure. So let's examine the relationship between exchange rate changes and the price adjustment of the good. When facing exchange rate changes, a firm may choose one of the foreign pricing strategy. So firstly, they may pass on the shock fully to its selling prices. So when there's a rising in the labor cost or manufacturing cost, they will pass on this to their customer through the selling price. And this is called a complete pass-through. And secondly, oh, sorry, there's a mistake here. So secondly, there can be a fully absorb the shock to keep the selling price unchanged. So whether there's an increase in labor costs, in production costs, or whatever cost that it may have, it will not pass on this to its customer through the selling price. So this is called a no pass-through. And thirdly, the third pricing strategy is do some combination between the above two strategies. That is, it can partially pass on the shock to its customer 50-50, or it cannot pass on at all. So this is called a partial pass-through. So these are the three pricing strategies that a firm can do. So for example, see Exhibit 9.11. Again, we have a pass-through coefficient which measure how much the firms and in which industry they are and how much they pass on the effects of the changes in their operating prices to their customer. So these are the pass-through coefficients, and it can be measured as. So the coefficient would be 1 for a complete pass-through or 0 for no pass-through at all. So, and it is important to note that the partial pass-through is quite common, but vary in a great deal across the industry. So this also depends on which industry the firm belongs to. For example, if you're analyzing a car company, there might not be a pass-through, but if you are analyzing a food company, then this may have a full pass-through because it's affected by how much the farmer has to grow veggie, and it pass on through a supply chains. So you can see a difference between industry. And the import prices would be affected relatively little by the exchange rate changes in the industry with a low product differentiations, and therefore there's a high demand elasticities. So product differentiations mean there's a very low in their products, low similarities in their products. And in contrast, in industry with a high degree of product differentiations, there will be a low demand elasticities, and the import price will therefore tend to change more as the exchange rate changes. So this depends on whether the industry is in a high product differentiation industry and whether there's a low or high demand elasticities. So question, discuss the implication of the purchasing power parity or the PPP for the operating exposure. So the answer is, so if the exchange rate change are matched by the inflation rates, the differentiation between the countries, the firm's competitive position will therefore not be changed by the exchange rate changes, and firms are therefore not subjected to the operating exposure. So this is how PPP come into play with the operating exposure. I will update the slides later on, so no need to write down. And as for the managing the operating exposure, there are a number of factors you need to consider. So first is selecting a low-cost production site. Second is a flexible sourcing policy. Third is diversification of the market. And there will be an R&D and production differentiation. And lastly, financial hedging. And we will go into details in each of this. So managing the operating exposure require a long-term operating adjustments, and the adjustment or decision are relating to the marketing, productions, and finance in your company. So firstly, the marketing management adjustment. So there can be a market selection by using the pricing advantage to carve out the market share, whether it's domestic or a foreign market. So whether you decide it's a domestic market or a foreign market, you can use pricing advantage. B is the pricing strategy. So if the home currency value falls, the exporter gains competitive advantage by increasing the unit profitabilities and all the market shares. And secondly, if there's a higher price elasticities of demand, that, for example, if demand grows, then also the price will increase. Like iPhone, for example, when it come out early, then there's a price elasticities. So the more currency risk the firm faced by products substitution. And following the home currency depreciations, the local firm may have much more freedom in its pricing. So this depends on whether your home currency is appreciating or depreciating. It will also affect the pricing strategy. And then C is the product strategy. So exchange rate change may alter first the timing of the new product introductions or the deletions. And secondly is the product innovation for decreasing elasticities. So when the demand falls, as you could see, iPhone start coming out with iPhone 5. After iPhone 5 become old, they again come out with a new version. So this is the product strategy. And the timing of the new product. Is it soon enough? Is it too soon or too late? Secondly is the product management adjustments. So first there can be an input mix, a shift in the production among the plants and the plant location itself, and the rising into the productivities. And how do we plan for exchange rate changes? So with a better planning and more competitive options, firm can change strategy substantially before the impact of an currency changes make itself felt. So the implication for this is the compactions of adjustment period following an exchange rate changes. And fourthly is the financial management of the exchange rate risk, the roles of the financial managers in the marketing and in the production. So firstly, provide the local manager with a forecast of the inflations and exchange rate changes. So there can be data from the Bank of Thailand, for example, with the inflation rate expectation in the next quarter. So this need to be updated with the financial manager in order for them to manage their exchange rate risk. And then identified and focus on the competitive exposure. And next is the design, the evaluation criteria so that operating managers neither rewarded or be penalized for an unexpected exchange rate changes. So there need to be a criteria to evaluate the managers whether or not he has done enough to manage the exchange rate risk. So in order for him to have an incentive to keep on managing the exchange rate exposure to be as low as possible, then there needs to be an estimate and hedge the operating exposure after the adjustment are made. And next is the currency matching between the asset and liabilities and the cash flows. So these are the tasks that the managers has to go through in managing the operating exposure. So what are some of the techniques that firm use in managing the operating exposure? So when you choose the company for your projects, you may see that some may decide to shift the locations to somewhere else because of the low cost of productions. And this happened increasingly with particularly for Thailand, as you know that we have increased the labor cost to 300 baht recently. So many multinational companies are now moving elsewhere like Myanmar or Vietnam, which has a lower cost of productions. So when the domestic currency is strong and is expected to become stronger, so this will erode competitive positions of the firms, and it can choose to locate the production facilities in foreign countries where the costs are lower due to either the undervalue of the currency or the underprice factor of productions. For example, in Vietnam, they may have a lower cost of standard of living than in Thailand. Or for example, Honda, they built the North American factory in response to a stronger yen. But later, Honda found itself importing more cars from Japan due to a weak yen. So these are some of the examples. And we see that this also happened to Toyota in our textbook. So this is from page 235. in the international finance in practice. So the strong yen and Toyota choice. So facing a strong yen in the recent year, it had made the Japanese export more expensive because when the currency appreciated, it make export more expensive. It hurt the exporter. And Toyota, as the Japanese biggest car maker, chose to shift its production from Japan to the U.S. manufacturing facilities where the production costs are lower. And Toyota planned to boost the U.S. production by more than 50% by 1996 compared with 1993. So this example is rather old. So consequently, Toyota expected that its export to the U.S. will decline by 30% over the same period, because of it chose to have a production site in the U.S. So the car maker also planned to double its production of engines at its Georgetown in Kentucky, USA. And in addition to substantially boosting the car production in Georgetown factory, Toyota also shifted the productions of all its pickup truck sold in the U.S. from Japan to California. So you could see that there are now different kind of product line that are being chosen by Toyota to be made in U.S. and then in Japan. So as a result, American-built vehicle will account for more than 60% of Toyota U.S. sales in 1996. And this is about 800,000 units compared with the 46% in 1993. And then Toyota also will boost its export from America to about 80,000 vehicles by 1996. So an increase of about 60% from 50,000 units exported in 1993. The company then expected that the U.S. job will grow by 23% because of this shift in the production site. And at the same time, procurement of U.S. parts and material will rise about 40% to 6.45 billion from 4.65 billion in 1993. And in addition to changing the productions and sourcings to the Toyota in the U.S., the company is using these attractive lease deals to help close the price gap on the import car. And since the company doesn't have to raise monthly leasing fee in step with the rising yen, the car remains more attractive to U.S. consumer, although the company risks taking losses upon resale. And although the shifting production to the U.S. helped Toyota to get out of the dollar-yen problem and maintain its market share in the U.S., it adds to the excess capacity problem of Toyota and led to the underutilization of domestic plant and job losses. So because it shifted its factory to the U.S., there has been a lot of job loss in Japan. And a persistent strong yen can result in hollowing out of the Japanese economy, as some worries. So this is quite an old example of Toyota back in 1993, but recently there's also a strong yen coupled with the earthquake that happened in Japan. So this also caused Toyota to make a decision again, and we'll see example.
Japanese stock market, I think Japanese stock market is now providing the very opportunistic investment opportunity from the recovery from the disaster last year and also recovery from the supply chain disruption in Thailand. all combined, the corporate earnings is now very resilient, very strong. That's why I'm thinking that the Japanese market is providing the investment opportunity in the upside.
How is the strong yen affecting Japanese companies? It must be hurting their exporters.
Yes, stronger Japanese yen is both negative for the Japanese export-oriented company. But if I talk about the impact on the corporate earnings in the Japanese market, perhaps the 10% yen appreciation just hurts the corporate earnings just 5%. So just stronger Japanese yen is not necessarily negative for the investor with a base currency like US dollar.
All right. Now, what's your view of China, and how are you playing it?
I think the China economy is now approaching to the bottom and to recover sometimes in the next 3 to 6 months horizon. That's a view in China. We think that the China economy is soft landing, and also one of the ways to play China is to have the overweight position in a resource or basic material company, perhaps in Australia or Indonesia.
Do you have any favorite markets? Not China, ex-Japan. What else do you like in Asia?
Our favorite place at this moment is the Southeast Asian region, smaller country like Thailand and the Philippines. Especially in the Philippines, which is a very small market in the Asian region, but we expect the country credit rating to be upgraded from the BB to BBB, perhaps sometimes in the next 12 to 18 months. That's why that may have big impact on the equity market in the Philippines. That's the experience that we had in Indonesia last year. That's why we like Philippines or other Asian small market.
Finally, how important is the strength of the American economy to Asia's economies? Because we keep hearing that we need a strong Asian consumer. How linked is it still to America?
I think that the Asian consumer space is now very secular growth trend, which is very independent from the American economy. Despite the weak American economy, perhaps the Asian economy will continue to grow.
This market is
stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to...
Sorry, the computer is a bit slow.
declining, falling to a single digit.
ผิวดูกระจ่างใสสำคัญสำหรับฉันเคยคิดว่าแค่ดูกระจ่างใสขึ้นก็พอแล้วแต่ Illumination Essence EX ไม่เพียงให้ผิวดูกระจ่างใสแต่ยังช่วยผิวดูเปล่งประกายเจิดจรัส
SK2 Illumination Essence EX
เพื่อผิวดูเปล่งประกายเจิดจรัส
Okay, maybe we show it at the end. I can't just get it working. Okay, so that's an example of selecting a low production site. Everything is slow today. Sorry. It's not even okay. Here come. So also, a firm can choose to establish and maintain production facilities in multiple countries in order to deal with the effects of changes in the exchange rate. So not only in one country, it can set up in a multiple country like Nestle. It has in Africa, Asia, in Europe, so in every continent, in order to mitigate or to reduce the effects of the exchange rate, since it sells its product in all of these countries. So maintaining multiple manufacturing sites, however, can prevent the firm from taking the advantages of the economy of scales or the rising in the cost of productions. And the resulting cost of the higher costs can partially be offset the advantages of maintaining this multiple production sites.
Japan's exports slowed for an 8th straight month in October as a strong Japanese yen and waning global demand cloud the nation's economic outlook. Although exports rose nearly 8% last month from a year earlier, the growth rate has been steadily declining, falling to a single digit in October, according to latest figures released by Japan's finance ministry. Exports slowed as shipments of cars, machinery, and semiconductor-related equipment grew at a slower pace. One positive element, however, was exports to China. Shipments to the biggest destination for Japanese goods rose more than 17%, faster than the 10% rise in the previous month. Analysts say overseas demand for Japanese goods is expected to pick up next year. But conflict in the Korean Peninsula, China's monetary policy tightening, and European sovereign debt woes pose risks to the outlook. Financial markets shrugged off the trade data, with the Nikkei index opening up higher on Thursday as gains on Wall Street prompted short covering. Toshimaida, Reuters, Tokyo.
So that's an example of how exporting can be hurt when the currency appreciated, the home currency, which in this case is Japan. So the question is, what are the advantage and some disadvantage of the financial hedgings of the firm's operating exposure vis-a-vis operational hedge, such as relocating its manufacturing sites? So what are some of the advantage and disadvantage of this? So financial hedging can be implemented quickly with a relatively low cost, but it is also difficult to hedge against a long-term and real exposure with a financial contracts. And on the other hand, operational hedges are costly and time-consuming and not easily reversible. So these are the main difference between the two. Financial hedging are low in cost, whereas operational hedge are costly and time-consuming. So you can discuss this if your company is financial hedging or not hedging. And then we go on to the flexible sourcing policy. Previously, we looked at why firms shift to other countries. Now, even if firm has manufacturing facilities only in the domestic countries, it can substantially lessen the effects of exchange rate changes by sourcing from where the input costs are low. So it doesn't have to go on and have manufacturing sites elsewhere. It can input the materials from where there's low cost. So sourcing does not apply only to components, but firm can also hire low-cost worker from foreign countries instead of high-cost domestic worker in order to be competitive. And we see this example in Thailand. As you may notice, now we have more foreign worker like from Myanmar, as the Thai worker all require the 300 minimum standard wages. So a lot of companies and particularly factories are now hiring Myanmese worker instead of Thai. And another example is with Japan Airlines, who hired the foreign crews to remain competitive in the international routes in the face of a stronger yen. But later it contemplate a reverse strategy in the face of a weak yen and a rising domestic unemployment. So the companies see that when there's a strong yen, it hire recruit the domestic worker. When there's a weak yen, it's another way around. So when there's a strong yen, it hire international staff, and where there's a weak yen, it hire a domestic staff. So this is its strategy. And we could also diversify the market if we want to manage the operational exposure. So this is another way to deal with exchange exposure, by selling in multiple markets to make advantage of the economy of scales and diversifications of exchange rate risk. So as long as the exchange rate does not always move in the same direction, for example, if the Thai baht go up, the yen go down, the firm can stabilize its operating cash flows by diversifying its export markets. So not only exporting to the usual place like Japan, US, or Europe, it could diversify its markets, for example, to China, to Malaysia, Indonesia, or our neighboring countries. So diversification means not putting all your egg in one basket. So if you put all your egg in one basket and you drop the basket, then you will lose all the egg. But if you diversify by putting the egg in different basket, if one drop, the other will remain there. So this is the basic idea of diversifications. But the expansion into a new business should also be justified on its own right. This is because the expansion can also bring about inefficiency and also losses. So you need to consider carefully when you want to diversify the market that you entered into. So question, discuss the advantages and the disadvantages of maintaining multiple manufacturing sites as a hedge against the exchange rate exposure. So we just discussed about that. That is, to establish multiple manufacturing sites can be effective in managing the exchange rate risk exposure. However, it can be also costly because the firm may not be able to take the advantage of the economy of scales. And let's evaluate these statements. So a firm can reduce its currency exposure by diversifying across different business lines. So if you are doing, for example, a car manufacturing and you want to diversify operational exposure, you decide to go and enter into a food business. So how would this be possible? So conglomerates or multinational companies' expansion may be too costly as a means of hedging this exchange rate risk exposure, and investment in a different line of business must be made on its own merits. For example, if you produce car and then decide to go on and produce food, this is not on its own merit because it's totally different line of business, and it may not have a cost effectiveness because your productions or your raw materials does not relate at all to the new industry, which is the food industry. So you also need to be careful when you want to diversify into a different line of business. Another way to manage the operational exposure is with R&D. Who know what it stands for? R&D. Yeah, research and developments and product differentiations. So investment in R&D can allow firms to maintain and strengthening its competitive positions in the face of the adverse exchange rate movement. So when there's a bad exchange rate movement against you, R&D can help to maintain your competitive positions, and we will see why with an example. So a successful research and developments will allow for cost cutting, enhanced productivity, product differentiations, and successful product differentiation, that means that your product is different from your competitors, will give your firm less elastic demand, and which may translate into less exchange rate risk. So let's see some of the example. Finally, financial hedging. So the goal is to stabilize the firm cash flows in the near term, and financial hedging is different from operational hedging, because financial hedging involves, as we see last week, the use of derivatives such as future, forward, options, currency options, for example. So now you have learned today economic exposure, operational exposure, and now you can use financial hedging to hedge it. So question is, the exchange rate uncertainty may not necessarily mean that the firm face exchange risk exposure. So explain why this might be the case. This might be the case because a firm can have a natural hedging position due to, for example, it already has a diversified market, already has a flexible sourcing capabilities, for example. So this is already a natural hedge. It reduces the risk by itself already. And furthermore, to the extent that PPP or purchasing power parity holds, the nominal exchange rate do not influence the firm competitive positions. Under these circumstances, therefore, the firms do not need to worry about exchange rate risk exposure. So under a natural hedge and PPP hold. Okay, so we have lunch break. And sorry, I already finished the slide for this week. So can we resume at 2 p.m.? I need to prepare more. Okay, thank you. So I think I will go on to chapter 16, which is foreign direct investment, so that you can have a better preparation of your project, because it directly involved with foreign direct investment. So my switch with Jang, right? Okay. So the third group is right now. Okay, and Coke. Okay. Teacher ไม่รู้จัก Coke anymore. Coca-Cola. Fourth group น้ำพลอยแอนนิดหน่อยค่ะ Samsung. Okay. And the fifth, you change member? Okay. With Katnui. Nui change with who? Miu. Okay. And And the company you have chosen is Apple. And the sixth group, Ton, Mai, and Pim. You guys switch around. With Pat. So Pat is changed with Mai. Okay. Okay, so is it right? The sixth group, Ton, Pat, and Pim. Tisco. Or Briscoe. B-R-I-S. Or Bridge. Or Bridgestone. Just do it. Okay, so everyone confirm their companies. Kellogg, Walmart, Coca-Cola. So far, I see a lot of American. Only one Japanese and one Korea. Okay, that would be interesting. Okay, so with regard to that, I will show you an example from the book and how they have analyzed the company exposure. So they will be relevant to your projects, okay? Okay, so this is a case application on page 237. It is the company is Merck. Anyone know what this company does? Merck is quite a big multinational company. It's in the pharmaceuticals, production of medicines. Okay. So in this example, it is a US-based company. So we will see what is its foreign exchange risk and how does it affect the companies. Okay, so Merck, as I told you, primarily develops, produce, and market the health care pharmaceuticals. The company operates in more than 100 countries. So this is how you might go on and introduce the firms that you have chosen. So give me the number of countries they operate in, what is its sales worldwide, and what is its market share. So what is the current market share as compared to other competitors in the market? So Merck's major foreign competitors are the European firms and emerging Japanese firms. So in the case of Coca-Cola, for example, you might give me who is the main competitors and how is it doing worldwide. So Merck is among the most internationally oriented U.S. pharmaceutical companies, with overseas asset accounting for about 40% of the firm's total asset. And 50% of its sales are made overseas. So how is your company doing? Is it a lot of assets are being based overseas? And what is its sales in terms of the percentage being made overseas as compared to its own home country. So as is typical in the pharmaceutical industry, Merck established overseas subsidiary. So does your company has a subsidiary, or is it a branch or whatsoever? So this subsidiary number about 70 and are responsible for finishing imported products and marketing in the local market of incorporation. So does your company has a production site overseas, or does it import the goods that produced in the home country and sell it in other markets? So sales are denominated in a local currency, and thus the company is directly affected by exchange fluctuation. Again, does your company you has chosen the sales dominated in USD, or is it dominated in other local currency? So costs of Merck are incurred partly in USD for basic manufacturing and research, and partly in terms of the local currency for finishing, marketing, distribution, and so on. So you might give me an example whether it's sales, distribution, or marketing department. Is it based in the home country or based elsewhere? So Merck found that cost and revenue were not matching in individual currency. This is because of the concentration of research, manufacturing, and headquarters, which is operated in its own country in USD. So again, in this case, you can elaborate whether your R&D research department is in home country, the manufacturing, its headquarters, where it is located, and how does this affected the costs and revenues of your companies. So to reduce the currency mismatch, Merck first considered the possibility of redeploying resources in order to shift the dollar cost to other currency. So this is its first strategy. So to reduce the currency mismatch, because its costs are being made in USD, but revenue in other kind of currency that they sell to. So the company, however, decided that relocating employee and manufacturing research site was not practical and cost-effective way of dealing with exchange exposure. So the company realized that by relocating its employee in other country, this is not working for them. So having decided that operational hedging was not appropriate, remember we studied today operational exposure. So this involved with how the company operate, where it's manufacturing, how does it employ its employees. So these are all under operational hedging. So Merck considered the alternative of financial hedging. So it says that operational hedging is not working. So now it's moving on to a financial hedging. So what is financial hedging? We studied that there are many different ways, which are, for example, using derivative like future, forward, option, for example. So Merck developed a 5-step procedure for financial hedging. So firstly is exchange forecasting. Secondly, assessing strategic plan impact. Third, hedging rationales. Fourth, financial instrument. And lastly, hedging programs. So you might go and consider these 5 steps in your research, in your report, and how your companies, whether does it follow these steps or it has other kind of strategy that it use. Okay. So with exchange forecasting, the first step involves revealing the likelihood of adverse exchange movements. So this requires forecasting. If your company is Coca-Cola, you might consider whether USD will appreciate or depreciate against the currency that your product is selling in other country. For example, in euro, so how will the trend of the exchange rate be in the next few years? So you might go and search on the internet to see what the guru or what the exchange rate forecaster have forecast about US and USD, Euro and USD in the next few years. Secondly, is involved with assessing strategic plan impacts. So once the future exchange rate ranges are estimated, cash flows and earnings are projected and compared under alternative exchange rate scenarios such as strong dollar or weak dollar, then this projection are made on the 5-year cumulative basis rather than on a year-to-year basis, because of cumulative result provide more useful information concerning the magnitude of the exchange exposure associated with the company long-range plan. So basically what it means is that Merck, instead of looking at the year-to-year basis, what it does is it used the forecast in the first step and used to plan a long-term plan, a 5-year plan for its hedging strategy. Okay, so it say that it gives more information rather than looking at the short-term ranges. But this again might be different for other companies because, as I could see, Coca-Cola is in the food industry, Nike is a clothing, so it might change with different scenario. And third step is then deciding whether to hedge. So after deciding whether to hedge exchange exposure, Merck focus on the objective of maximizing the long-term cash flows and on the potential effects of exchange rate movements on the firm ability to meet its strategic objective. So then after they decide that they would hedge this exchange exposure, they focus on whether this plan can maximize the long-term cash flows that they aiming for. Okay. So because the volatile cash flow can adversely affect the firm's ability to implement the strategic plan, especially investment in R&D, which is firms in pharmaceuticals. As you know, they have to compete by developing a new kind of drugs so that they could be more advanced than their competitors. So R&D is the main department for their companies. So to succeed in this highly competitive industry, the company need to make a long-term commitment to a high level of research fundings. But the cash flow uncertainty caused by the volatile exchange make it difficult to justify the high level of research spending. So the management decide to hedge in order to reduce these potential effects of volatile exchange rate on the future cash flows. So again, depends on the firm you choose. Here, Merck depend highly on R&D, so it need to make a long-term commitment in this area. But for your companies, they may consider other department, like for example, Coca-Cola might be aiming at the marketing because they need to compete with other competitors, right? Instead of R&D might come after. I'm not sure, don't quote me, you need to read by yourself. Just an example. And the fourth step is selecting the hedging instruments. So the objective was to select the most cost-effective hedging tool that accommodate the company risk preference. So here now they're choosing which tool they would like to use. And among other hedging tools such as forward, currency contract, foreign exchange borrowing, and currency option, Merck choose to use the currency options. So again, then you go on and elaborate which kind of hedging tool does your company choose. I think R&D might involve with technology company like Samsung, so you might have a look at that. Okay. So lastly, constructing a hedging program. So having selected the currency option as their hedging tools, the company still had to formulate an implementation strategy. So after choosing it, now you have to go on and read whether this is successful to hedge the foreign exchange risk. So Merck decided to firstly hedge for a multi-year period using long-dated option contract. Secondly, they don't want to use far out of the money options to save costs. And thirdly, hedge only on a partial basis, with the remainder self-insured. So again, you need to decide which kind of strategy they use and then how do they implement that derivative. Okay, that is all I would like to say. So this is a very good example of how you would go about and doing your projects. So have a good read by yourself and discuss among your team member. Hope that helped. So since we have a bit more time left, I just continue on with chapter 16, which is supposed to be for next lecture. Okay. So the PowerPoint lecture note I will send to Kun Bongkot, and hopefully she will be able to give you by sometime next week, together with the solution for the test. So chapter 16 is about your project. What exactly is that? Is the foreign direct investment and a cross-border acquisitions. So mostly the multinational firm would fall into these categories. So as you could see, there are multinational firms all over the world, and we see it by even thinking about it. Like if you go to supermarkets or go to department store, you will see, oh, McDonald's, Burger King, Apple, Nike, all of this without realizing that they are multinational firms. So this lecture will outline the global trend in the foreign direct investment. So why do firms need to invest overseas? Of course, we cannot live in isolation, and therefore companies need to go out and seek more customers and invest overseas. And in doing foreign direct investment, of course, there are some barriers, such as trade barriers, there are imperfect labor market, intangible asset, the vertical integrations, product life cycle, shareholder diversification, for example. And foreign direct investment can involve cross-border mergers and acquisitions, and there can be political risk involved when doing foreign direct investment. So firstly, what is foreign direct investment? So firms become multinational when they undertake a foreign direct investment. That is, it involves the establishment or the setting up of a new production facilities in the foreign countries, or it merge or acquire existing foreign business in other countries. For example, Ford, which has acquired Mazda, which is a Japanese car manufacturer, as well as Jaguar, which is a British automobile companies. So whether the FDI involved is, for example, greenfield investment. This is the building of brand new product facilities, or it can involve cross-border mergers and acquisition. Everyone understand what mergers and acquisition is? Usually they say M&A. So merger is when you have a company and your friend has a company and you decide to merge. So merging means you come together, merge company A and company B together to make one company. Acquisition come from the word acquire, A-C-Q-U-I-R-D, which means you take something. So when you want to acquire, you have a company and your friend or other person has a company and you want to take over that one. So this means you acquire that company. So it with the foreign direct investment, it can involve cross-border mergers. So you go out into another country and you merge or take over another companies. So it affords the multinational companies a measure of controls. So multinational therefore mean that it is more than one country. Because national is one, multi is many, so many countries. So FDI does represent an internal organizational expansions of the multinational companies. There are many factors which influence foreign direct investment and are related to factors that stimulate tradings. For example, it involves the ownerships of an entity abroad for production, for marketing your products or services, or you can go out and do R&D in other countries that have more high technologies than your home countries. Assess the raw materials or other resources. For example, Singapore, which is an isolated country with very limited land, but why is its economy such a booming economy without having any raw material inside the country? This is because it has a know-how, it has it go out and it merge and acquire other countries, and therefore it access the raw material or other resources from other countries. Another factor is the parent company has direct managerial controls. So depending on its extent of ownerships and on other contractual term of the FDI. So parent company is the main companies, your original one. So when you go and acquire other companies, the parent company still can control the subsidiaries. That's what it means. So no managerial involvement would mean there would be a portfolio investment. So if you go out and acquire other firms, but without managerial involvement, this would be like you go out and invest in a stock. So there's to diversify your investment, for example. So this is called a portfolio investment. So recent trend in FDI often involve the setting up of a production facilities abroad. So the FDI outflow, what is the difference between outflow and inflow? So for example, Thailand, the FDI outflow would mean that a Thai firm go out abroad and merge, acquire, or setting up a new factory. Whereas the FDI inflow would mean that the foreign company come and set up their production site in Thailand. So this is inflow for Thailand, and outflow would mean we go out to other countries. So FDI outflow accounted for about 35 billion in 1975, and now as to 2000 it account for 1.3 trillion, and in 2003 it account for over 653 billion. So you could see that there's an increasing trend in the FDI outflows. As for the inflow from other countries, so from 1992 up to 2002, there's 292% compared to the trade, and up to 96%, and the world output is up to 28%. As for the FDI stocks, is that mean you go and invest in the stock markets elsewhere. So this also has an increasing trend from 3.5 trillion by 1997 to 7 trillion in 2002. So you could see that people become interactive with each other more and more in terms of the tradings. it become like a borderless. So there's no border between countries, especially with the establishment of the EUs, the AEC. So this has increased FDI inflow and outflow of these countries. So in 2002, almost 64,000 multinational companies had 850,000 foreign affiliated, 53 million employees, and 17.7 trillion in sales, and 8 trillion global export. So this is a huge number. The conclusion we could make is that FDI flow growing faster than the world trade and the world output. And global trend in the FDI is that the several developed nations are the sources of the FDI outflows. So because they are already a developed countries, they have more resources and a bigger company, so they often go out and acquire company elsewhere. So this most worldwide FDI come from this developed world. And this implies that multinational company domiciled in this country should have certain comparative advantages in undertaking the overseas investment projects. And both developing and developed nations are the recipients of inflow of FDI. Some developing countries like China and Mexico have begun to undertake FDI, albeit on a modest scale. And especially China, it is growing very quickly and become a target for FDI inflows for many countries. So let's look at some graph. So the average annual FDI in USD billion from 2004 to 2008. The purple is the outflows, and the dark light blue one is the inflow. So you can see that for US, it has a high FDI outflow. So this means that US firms go out and acquire companies elsewhere more than the companies from other countries invest in the US. So the outflow exceeds the inflows. However, for Japan, FDI inflow is higher than FDI outflows. So firms, for example, from US like to invest in Japan more than Japanese firms go out and invest elsewhere. And this is the same for France and Germany. So there are different kind of form of FDIs. For example, you could purchase an asset, and why not you shouldn't. So with the purchase of asset is that it is quick to enter into the market. You already have a local market know-how. You all know what know-how means, the know-how of technologies. So employees are already educated on how to do the work. And there can be local financing and may be possible. And this can eliminate competitors and buying of problems. And with new investment, so why should we start new investment and why not, rather than purchase of asset? So with new investment, there's no local entities available for sales. Therefore, you need to go there and make up a new investment. And local financial incentive, no inherent problems because you go and start a new one. A long lead time to generation of sales. Because of you're a new company, it may take you a while to get to know the countries, know the trend, the preference. Therefore, it may take longer time to generate sales rather than you go and buy another companies. And third form of FDI is international joint venture or JV. So in this case, there can be a share ownership with locals and or other non-local partners. So you go there and say that, okay, I want to make a JV agreement with you that I become 30%, I owe 30% of your companies or 50%, for example. And therefore, you share the risk with other partners. So with FDI, there can be 100% ownership when you go and take over another companies. There can be less than 100% ownership. That is in the case of the international joint venture. There can be strategic alliance, so it's non-equities. For example, with the Star Alliance, if you fly with Star Alliance, so this is kind of FDI. And that it could be in the form of franchising, licensing, or export, that is direct or indirect export. So why FDI over exporting? Because there can be high transportation costs and trade barriers. So rather than exporting, you go there and produce by yourself. There's no cost of transportation, shipping costs, or other tax or trade barriers. So FDI over licensing or franchising. So why don't you go and buy franchise from other companies like Starbucks, McDonald's, for example? This is because you need to retain, you want to retain the strategic control over your own companies and not letting anyone decide on the policies, how you work the company out. So there's a need to protect technological know-how. Maybe you have a very specific technological know-how that you don't want the other to know. For example, this involved in pharmaceutical industry or high-tech industry particularly. And there can be capabilities not suitable for licensing or franchising. And follow few main competitors with immediate strategic response. So this are all the reasons why we should do FDI. There can be eclectic paradigm of FDI. So what this means is that there's ownership advantage, which create monopolistic advantage to be used in the market abroad. For the unique ownership advantage will protect your ownership. For example, the brand, the technologies, the economy of scales, and management know-how. So in your project, for example, you might analyze so whether your company has all of this ownership advantage, whether it has a unique technology or it has a management know-how. So the FDI destination market must offer factors like land, capital, know-how, cost, quality of the labor, and economy of scales that are advantages for firms to locate its investment there. And this is linked to the trade theories. So there need to be an advantage for that firms want to do FDI in other countries. There also need to be internationalization advantages. What this means is that the transaction cost of an arm's length relationship, such as licensing export, higher than managing the activities within the MNC boundaries. So let's see some of the examples. So let's see why people want to invest in China.
How do you start your day so you make better investment decisions?
You watch Bloomberg Surveillance to find out what the markets are doing, and you talk to smart people. Bloomberg Surveillance, weekdays at 6 a.m. Eastern on Bloomberg Television.
Joining me now is Ziwei Zhang, the chief China economist at Nomura International, who also spent 6 years of his life and his career at the IMF between 2002 and 2008. Many thanks for coming in, Ziwei. First of all, the reaction to the FDI. Far worse than forecast. 6 months in a row of declines. What does it say to us about the Chinese story now?
Very bad number, again, consistent with the batch of very weak data we got last week. So trade data is bad. Production data last week was also bad, and this time around FDI also pointing to the same direction. So very weak economy at this moment.
So where do you see, with all these numbers coming out again, painting a pretty bleak picture, the Chinese economy growing or heading towards? Have you changed your growth forecast, for example, because of these numbers?
We do see downside risk becoming higher. We still need a little bit more data points to confirm this downward trend. Now the big question is whether the government will loosen policy aggressively to revert this downward trend in the economy.
You've been pretty critical. You said that the urgency for policy easing is obvious. In fact, you expect another RRR cut soon, but that cut in the reserve requirement ratio, you say, I quote, is not enough to reverse the trend of economic weakness in our view, as it helps loan supply rather than demand. The government needs to do more on fiscal side to boost domestic demand. How about an interest rate cut?
That's right. I think the possibility of interest rate cut is also rising, although it's still below 50%. Keep in mind that the government had a choice to cut either interest rate or RRR over the past weekend, and they chose RRR. And so they didn't do as much as they could. And down the road, on the fiscal side, we would expect them to do more. Otherwise, the economy will probably slow down further.
Okay, let's give you two hands. One is your advisor, the PBOC. What should they do right now?
On the PBOC side,
to be ahead of the curve.
Well, what should be done, I think, loan supply certainly need to be increased, and the interest rate, particularly on lending side, they could consider actually cutting interest rate. That's what should be done. Probably can help the economy more. But I think even more important is on fiscal side, infrastructure investment. That kind of spending have to come up. The monetary policy alone cannot solve the problem.
So then, the second hat, advising the government, you mentioned the fiscal measures of 2008. What should they be doing? What exactly fiscal measures can be done to really stimulate growth?
Kind of similar to what they did 3 years ago, but I think the size need to be controlled. Certainly cannot be as big as last time around. Infrastructure investment, for instance, a highway, airport. I understand the government already approved some projects in the past week just to speed up spending a little bit, probably in response to this weak data. And we would expect more measures like that to come in the next several weeks.
Is it affected by the change of leadership?
Well, it is. I think the political dimension certainly is related to the economic policy. Economic policy is usually delayed when there is a transition, either in China or in other countries. That's reality. And I do think that the government, need to reach consensus. The new leaders and the current leaders need to reach consensus on how to deal with the economy. That certainly delay policy reaction.
So if there's this inaction or impasse again, they don't actually reach an agreement again, what a year to really choose to change, not they chose to do, but again, what a year for a change of leadership. What's going to happen if they don't take action? Where will the Chinese economy head towards?
That will certainly face more downside risk, and GDP growth could potentially drop below 8. We're getting very close. First quarter is only 8.1, and the April data, if continue the current trend, the Q2 GDP growth will probably be below 8% if the government doesn't do enough on policy front.
Many say obviously 8% again, obviously in Euroland, but they would grab at 8%. But again, in China, that's still a low figure, isn't it? Right. I mean, what is a worrying figure for the investor out there for the China follower? Is it a 7.5% figure, or is it less than that?
Well, the market would generally vary much more on the downside. Remember, last year, investors were worried that growth could potentially certainly below 8 and dropping, say, below 7, hard landing kind of story. That kind of worry certainly point to a number much lower than 8.
Many thanks for coming in there. Chief China economist at Nomura and also formerly of the IMF.
Okay, so as the video shows, they say that politics, government policies, and all of there are a number of factors that could affect FDI.
FXCM offers the ability to place trades directly on real-time charts.
Sorry. So yes, as the man said, there are political risks, other government policies, as well as other economic factors that could affect FDI and how, for example, the yuan dollar that the guy say that is changing, and this affect the FDI inflow and outflows of the countries. So now we will see that the reason why firms invest overseas. So first, they need to consider the trade barriers that the guy was saying. For example, include the government's policies, and there can be a labor imperfections, intangible asset, vertical integrations. There can be different product life cycles and shareholder diversifications. As for the government policies with the FDI, for the radical views, the inbound of the FDI may be harmful. This is because some are imperialist dominators. For example, the export hosts to the advantage of the home countries, and this can extract profit from the host countries and give nothing back. Or they can keep the LDC backward and dependent for investment, technologies, and job. The other view is the free market view, in that the FDI should be encouraged. So rather than harmful, this side say that it should encourage FDI. This, for example, economists like Adam Smith, Ricardo's, the international production should be distributed per the national comparative advantage. That means that a multinational company should will increases the world economy efficiency, because it will bring to bear unique ownership advantages and add to the local economy comparative advantage. So as for the home country, the outward FDI encouragement because the risk reduction in the policy. That is for the financing, insurance, and tax incentive. But for the outward FDI restriction, this is because of the national security and the balance of payment. The country may be in balance of payment deficit or surplus, so this will affect the FDI restriction. As for the host countries, the inward FDI encouragement is for the investment incentive, the job creation incentive, because if foreign company come to invest in your country, it will create jobs. So they want to encourage because of this. And the inward FDI restriction, you don't want anyone to come into your countries because of the ownership extent restriction in terms of the national security, as we have seen with AIS, the Temasek and the Shin Corporation, This is concerned the national security that the Singaporean will have over the Thai telecommunications, and the local nationals can safeguard host country interests. So again, this is a matter of securities. Other trade barriers, the government action led to the market imperfections because there can be benefit and there can be also costs. As for the benefit, this involves the resource transfer, there's employment, and again balance of payment because of the import substitutions and the source of export increase. As for the disadvantages, the adverse effects on the balance of payment because the capital inflow will follow by capital outflow and profit. So once the company come invest in your country, they will make profit and then bring back the profit to their own countries. There can be production input importations, and there can be threat to the national sovereignty and autonomy. For the trade barriers, so what are trade barriers? This include taxes or tariff. There can be quota on the imported good, and other restriction on the free flow of goods, services, and people. So the government might limit the number of goods or services that can be brought into the countries. So the trade barrier can also arise naturally due to the high transportation costs. And this is particularly for low value to weighted goods. So in deciding whether you should do FDI or not, this is some of the framework. So the first thing to consider is, are transportation costs high? Whether shipping your products to other country, is it cheap or is it expensive? So if it's cheap, then is there an import barriers that we have talked before? Is there tariff? Is there quota on the goods and services? If there is none, then you should export. So if the transportation cost is low and there's no import barrier, then you should consider on exporting your products. But if the transportation costs are high, so it's not how easy to license. If it's yes, then is there any tight control over the foreign operation required? If it's no, then is know-how valuable and is protection possible? If it's no, then it should be licensing. If it's yes, there is a know-how is vulnerable and its protection is also possible, then you should do FDI. For example, and Starbucks is everywhere. Okay, so I want to end my lecture up to here, and we will continue with FDI again next week. Yeah, I have some material ready at home for the FDI, so I want to bring it over. Okay, sorry for finishing early. Okay, so hopefully you can get together and think something about the group projects. Yeah. ได้ค่ะ